now that the circus that was the US election has eventually left town, leaving one of its clowns behind, I thought it might be instructive to look at what has occurred and look at it from the context of how a strategic trader views these sorts of problems. But the first point I want to make is a very, very important one, and it seems to be one that has escaped the majority of pundits, and that is, irrespective of what everybody said, what everybody's prognostication was, the world didn't end. The sun came up, just as it has for 4.5 billion years, and just as it will continue to do long after you and I have gone. And this is an important message that I think people miss. Governments come and go. Politicians come and go. Markets don't. And this is a very, very important thing. And we have a tendency to overstate the importance of events as they occur. This occurs because of the profound breathless hyperbole of the news media. Now, you've got to remember that the majority of news is brought to us by people who have a degree in media studies. Think about that for a moment. That means that for 3 years, they've sat in front of a television and watched reality programs. They then comment on what they see in the world through this lens of made-up, carefully structured reality TV. They don't have an ability to take a step back and look at the world as it actually is and to place it into some sort of context. Markets and trading are a very long game. And so long as the sun continues to come up, that game will continue. And given that there is no chance that the sun will not come up, we're faced with an issue. And the issue is that every time the sun comes up, every time there's an event, we have an opportunity. This is the crux of what markets present to us. Markets present us with opportunity. But that opportunity does come with uncertainty. If there is no uncertainty, there is no possibility of making a profit. I can give you a completely riskless trade. Absolutely and totally riskless. It's called putting your money in the bank. You will get nothing for it, but you don't deserve anything for it because you have taken no risk. There are no free lunches. But circumstances always give us the possibility for profit. And they do this because circumstances change. Circumstance throws up opportunity. But opportunity is very context dependent. Consider this chart. This is a chart of the ASX 200 from yesterday and today when I'm recording this. You can see the shenanigans of yesterday. This is a 5-minute chart, so it's got a lot of data in it. You can see the market falling away. Recovery late in the day. Strong recovery today. This is a 5-minute chart. Therefore, it is extremely noisy, and there's no context to it. And unfortunately, traders get caught in this noise. They think there's something in there, but there is actually no signal in the noise. There is nothing in there at all. And we confuse noise for some form of opportunity. And the noisier we presume it is, the more opportunities we presume there are. And that's incorrect. And if we're to look at things in context and to place them in some form of historical narrative, we find something very interesting. And this graphic is from Bloomberg. And it looks at two things. It looks at the S&P 500 return the day after the vote, and then the return over the next 12 months. And you'll see something very interesting. There's no correlation, none whatsoever. The movement immediately after the vote is noise. The return over the next 12 months is the true narrative or trajectory of the market. And that's the one that counts. What happens on the day doesn't count. And I've spoken about this before. It is a noisy narrative. Granted, somebody will have made money on the day, but then somebody wins the lottery. And to put that into context, some people get hit by lightning. All of these are random lucky events. Trading is neither. And so we have to be very, very careful about our perceptions of the opportunities as they arise. But we are faced with a conundrum, and it is a very serious conundrum that everyone must solve in their own way. When we look at markets, there are probably around about 100 separate exchanges around the world. There's about 320 instrument types ranging from very, very strange hybrids through to derivatives, CFDs, indices, FX, commodities, through to standard shares. If I were to count the number of shares in the world on exchanges, I'd probably get a number around about 35,000. The problem is, though, that only a proportion of these are traded on very well-regulated exchanges that we have easy access to. This brings us to a harsh reality, and the harsh reality is this, that locally there are only about 300 local shares that demonstrate sufficient liquidity for one to be able to trade with any degree of confidence. We require liquidity because it aids in the price discovery process. The more liquid a share, the greater the price discovery. Therefore, the more valid the information coming from price is. There's more signal than noise, so there's more fidelity to what you're seeing. Unfortunately, people have a terrible tendency to trade shares that are rubbish, but that's a decision born of ignorance and ego. However, the problem with having only 300 local shares is that when you see this sort of chart and this style of shenanigans going on, your natural tendency is to panic and get caught up in it, simply because you're playing in a market that is effectively, to use an old analogy, really only an inch deep. And so this has a great deal of impact upon you. Add back into that the noise that comes from the media, and you can see why people make silly decisions. So we have rather breathless headlines like this from the Sydney Morning Herald. Our trading should always be strategic, not tactical. But most people think, if they think at all, they think tactically. They're very myopic in their approach to markets. So instead of taking a step back, taking a very deep breath and placing everything in context and everything within the true historical narrative, they get caught up in the noise and they do very, very, very silly things. And as an example of this tactical thinking, this inability to think strategically, to take a big step back, I offer this. This is a variation of a chart I've spoken on before, and it looks at the year-to-date return of a series of investment classes. The blocks coloured in purple are indices. Those in blue are commodities. You can see there is a disparity in return. The best performing instruments of this year to date have been commodities. They haven't been indices. Now granted, there will be the occasional share in there that does very, very well. That just happens. But as I've said before, and I'll state again very dogmatically, unless equity markets are running hard, that is, they are displaying all the characteristics of being in a very, very strong upward trend, you're simply wasting your time. However, when I present this sort of information to people, they tend to have some form of conniption, thinking it's a commodity, I could never possibly trade it. And granted, people who come into the mentor program for the first time think exactly the same thing, and I'll address that point in a moment. But I present people with a quiz, and the quiz is really quite simple, doesn't require any thinking at all. I present them with a series of charts, such as this one, and this one. And I ask them to tell me whether it is an index, an equity, a commodity, foreign exchange contract. You'll note they have no name on them. Nobody gets it right. And why does nobody get it right? Nobody gets it right because they are all indistinguishable from one another. All you're seeing is price action in its purity. And you'll note that I've placed a very, very simple trading system over the top of them. And I'll mention what it is in a moment. But it is impossible for people to tell the difference between share price chart, futures contract, FX. They're unable to do it. It is simply too hard. Why is it too hard? Well, it's too hard because they present identically. This raises the question as to why do they present identically? They present identically because markets are driven by people. Once you understand people and their motivations, and they really only have two broad motivations, fear and greed, and once you understand how to define and show who's actually in charge, then most of the problems surrounding very, very simple things like entry signals disappear. And actually giving a name to something becomes irrelevant because everything presents in the same way. It's simply data that you interpret. And you interpret using a strict set of rules. And you'll see with this very, very simple system, it catches most of the moves that it sets out to catch. Of course, putting in context that entry is the most irrelevant part of trading. For many people who don't understand a trade, it is the most important part for them, but their approach is completely incorrect. The aim of any form of thinking, any form of analysis, and it doesn't matter what form it takes, is to remove this noise. It is to get rid of this gibberish that we're all subjected to. But coming back to the notion of a system, the system I've applied to these charts actually comes from a recent Graduate of the Mentor program. The thing I will say about the system is it comes from someone who had never traded before, let alone trading a futures contract like soybean. But they've been able, because they accept that price is simply a form of data, and price presents itself in exactly the same way all the time, they've been able to build a system that catches the majority of moves, that sees the majority of things that need to be seen. But again, this sort of system places price in a context and within a deep historical context. So you get an understanding of trends. There's no need to be concerned about the noise. You'll notice there's nothing on this chart other than blue and red arrows. There doesn't need to be anything else. We can certainly add bits and pieces, bibs and bobs, but they don't add anything to the system. They make the trader feel more comfortable, but they don't actually add anything. So we're then faced with a question. It's a question that every trader has to face. And it's simply that when the sun comes up tomorrow, as it will, irrespective of what anybody says, what will you do to take advantage of the opportunities that are presented to you?